My name is Mushir Ahmed. I'm the founder and MD of FinStep Asia. I've been involved in the virtual assets and fintech world for the last decade. I come with a background in capital markets and a cumulative 20 years in financial services. I have previously also been the co-founder of the FinTech Association of Hong Kong and its inaugural general manager. Until recently, I was also a regulator with the Virtual Assets Regulatory Authority in Dubai as leading their risk function as well as grandfathering of existing firms. Our intention with this webinar is to get you up to speed on an introduction to virtual assets, as well as looking at blockchain and key functions of different blockchains. Right. So when we are looking at Hong Kong as a financial services center, one of the top three international financial centers, it has also been a hub for blockchain and virtual assets for over a decade, with some of the regulators here having designated Bitcoin as a virtual commodity almost 10 years ago, plus having a regulatory framework around different elements of virtual assets across the HKMA, the SFC, and the Hong Kong Customs and Excise Department. The government has also been promoting sustainable development of financial services across the virtual assets value chain, where the focus is on balancing financial innovation with risk mitigation and investor protection. Technology has transformed finance, starting with what fintech has done over the last 25 years and how blockchain and virtual assets are taking this into the next era of innovation and new business models. Regulatory regime launched by the Securities and Futures Commission will require investment and financial professionals like yourselves to upskill your knowledge of blockchain and virtual assets to not only better serve your clients, but also for you to understand newer products that are going to be coming up in the market as the ecosystem develops. Basic understanding of the regulation is quite important. And as we have highlighted, there'll be other sessions in the coming weeks looking at more deeper into the regulations. It is also very important for us to understand technologies that underpin virtual assets because the technology component is a key element of virtual assets. So keeping in step with this will enable you to better serve your clients and ensure that they have a robust understanding of the risk when you are conversing with them regarding these products. So blockchain as a technology is not necessarily very new, but it is part of an evolution of the internet starting from the 70s, where you would say it was Web 1.0, where you could only share basic data and content. There may be documents, and typically only for being able to read that. These would largely run on LANs or limited networks. Wasn't as global as we have currently. Then came Web 2.0, which was both read and write. This is the 2000s in general that you can talk about, where you started having interactive content, you had e-commerce, you had social media kicking in, platforms, plus infrastructure being developed through cloud and mobile. And this was largely controlled by some of the larger technology firms who were propagating their products globally. And then once blockchain started becoming a part of the conversation for the internet, as a layer on top of the internet, we then have a conversation where it becomes decentralized again, where people are able to share information on a peer-to-peer basis. It also provides an opportunity to build virtual economies on top of the social platforms or e-commerce platforms, but also looking at new networks that were created which have millions of users on their own in a separate manner, specifically on those networks alone. Plus, the infrastructure is largely blockchain clouds, which is supported by data centers and nodes in different parts of the world. So when we look at the evolution of blockchain itself, as I mentioned, it has been around in terms of some use from distributed ledger technology over the last 2 decades or so. However, the key element of the blockchain network that gained prominence was during 2008 when a person or a group of persons under the pseudonym Satoshi Nakamoto launched the Bitcoin white paper on 31st October 2008. And that led to the propagation and more understanding of blockchain and development of different technologies related to DLT over the last 17 years. So the Bitcoin network was launched after the global financial crisis in 2007, 2008. as a peer-to-peer version of electronic cash. It was meant to allow online payments to be sent directly from one party to another without going through a financial institution in a decentralized manner where the transactions are validated by a third party who's also part of the ecosystem versus using an intermediary, typically a financial institution, which would be a bank. The blockchains are distributed ledger technologies, forming a secure chain of information blocks. Each blocks can store a digital record of assets, whether it's physical or virtual, and we will touch more upon which kind of assets are popular. And new blocks are created over a specific period of time, and this information is secure, it's locked in, and cannot be tampered over time. The blockchain components are importantly the network, which is usually peer-to-peer. You have data ledger, which is the records, nodes which is being operated by key participants, especially miners in POV, and virtual assets wallet, which is your account essentially, plus cryptography and hash, which is encryption, and the working of POV blockchains is largely driven by cryptography and hash, plus the consensus mechanism, essentially the operating governance on how the network will operate, what will be the elements and what will be the services offered on certain networks, and the development of the technology itself. Lastly, smart contracts, a way of automating actions on a blockchain using technology. So we'll now dive into an overview of virtual assets. And once we complete that section, we'll then go a little deeper into looking at blockchain itself. Virtual assets in Hong Kong, as I mentioned, has been under the purview of our regulatory bodies for a few years. In particular, it has been defined as per the Section 53ZRA of the Anti-Money Laundering and Counterterrorism Financing Ordinance, the AMLO as it's well known. And virtual assets are subject to subsection 2, meaning a cryptographically secured digital representation of value, which is expressed as an account, a unit of account, or a store of economic value, and is used or intended to be used as a medium of exchange accepted by the public for any of the following purposes, which is payment for goods or services, discharge of a debt or investment, which is the payment of goods initially and services, what Bitcoin has probably started for, and then we built on to different products. Secondly, or it could be a unit of account is stored that provides rights, eligibility, or access to vote on the management. We see this with decentralized autonomous organizations, but also with public networks, where administration and governance of the affairs or to vote on any changes of the terms or any arrangement applicable to the cryptographically secured digital representation of value. These can also be transferred, stored, or traded electronically and satisfies other characteristics prescribed by the Commission under subsection 3A. Moreover, it is important to note a virtual asset can be a digital representation of value prescribed as a virtual asset by notice published under subsection 4A. Now, these regulations are also something that we will go into in our following webinars, so I would mind you to keep that in your top of your head if you're looking to understand and go deeper in the regulatory elements of virtual assets in Hong Kong. Touching upon the other definitions included in regulations as an overview, digital representation of value is excluded from the definition of virtual assets if it is issued by a central bank or an entity that performs a central bank, essentially what are known as the central bank digital currencies that are typically more, they use blockchains but can be more centralized than decentralized in that sense, are issued by a government of a jurisdiction or an entity by the government, is a limited purpose digital token, typically would apply for things such as non-fungible tokens if it is very limited purpose. It constitutes securities or a futures contract, in which case it is likely to fall under the securities regulations that exist or under the digital securities. In particular, you'd be minded to look at the circular that the SFC issued regarding tokenized securities in the last year. Or it constitutes any float or SVF deposit of a stored value facility as defined by the ordinance for stored value facilities. And lastly, of course, satisfies characteristics by the Commission. And if it is and it is also not considered a VA if it is a digital representation of value prescribed not to be a virtual asset by notice published under subsection 4B of the regulations. So when we look at virtual assets, you have different categories. Here we are looking at a few main categories in terms of description of these. Tokens are essentially your coins that we may have been used to playing. When you're playing a video game, you get a reward in terms of a coin, right? In a similar way, in virtual assets network, you have a token that is needed as a means of transferring data or value across the network, and this is what is typically owned by most participants. There are certain networks where there are no tokens involved, but those tend to be rare. Most networks in the blockchain ecosystem have tokens. The more common ones are utility tokens, which have a utility enabling users access to products and services on specific blockchain networks. They do not represent any ownership or share of profits of the network, so they're not like an equity. It is like owning a subscription that allows you to access the products on a network. Say you had Microsoft Office, you could then use those services across, and this is a representation of your subscription to Microsoft Office. Cryptocurrencies, meaning more so the payment tokens, which are used for making payments for a variety of services and products. One of the key initial use cases for cryptocurrency with Bitcoin was for payment tokens. Common use cases include for remittance and retail payments, as well as a next step, we are talking about stable coins, which have their value pegged to another assets through either a fixed mechanism or using algorithms and mathematical concepts to provide a stable price. These are commonly used across for converting from a fiat currency to a virtual asset to enable access to the virtual assets ecosystem. Before regulations started coming in across globally major financial centers, it was challenging for individuals to get access to cryptocurrencies directly using fiat currency, and stablecoins became that access point for many of them in what we call the on-off ramps per se, typically pegged to fiat currencies, but also to other virtual assets or commodities. Popular ones are typically pegged to major global currencies such as the US dollar, euro. To a certain extent, we're seeing progress in Hong Kong dollar stablecoin as well, while the others are pegged to Bitcoin and Ethereum among the popular stablecoins for VAs, and commodities such as gold. Lastly, in this section would be central bank digital currencies, which I've spoken about. They are issued by central banks representing their fiat currencies, and they are two types. One is retail currencies, which are specifically for consumer use cases, while wholesale are used for wholesale banking and cross-border trade by institutions, and are seeing more popularity than retail CBDs at this stage. The other major virtual asset categories would be non-fungible tokens, NFTs. There was a big drive of uptake of NFTs just after COVID in particular, but they also were a big driver in adoption of virtual assets globally. These tokens are a digital representation of unique ownership. For example, for those who aren't familiar, a fungible item would be something like a $100 bill that the HKMA issued. It could be a $100 note that has been issued by Standard Chartered or HSBC or Bank of China, and they are interchangeable. They are the representation of their value is the same, and they don't have a specific restriction in terms of that change. Whereas NFTs are unique ownership. They are assigned to a certain wallet to a person. They are numbered typically a lot more like a collectible or a limited edition issues. They can also have representation and properties which allow you to actions in some cases like access to a concert using your NFT or having benefits being part of a community. They have often been used for digital representation of art, digital collectibles, as well as virtual real estate. Real world tokenized assets typically are for tokenization of real world assets such as real estate, financial products such as securities and bonds, as also physical art. These are gaining in traction, and some of these would fall under digitized tokenized securities if they are financial products, but you're also having others that may represent real world assets for ease of liquidity, distribution, as well as fractionalization. Exchange tokens are typically issued by exchanges for accessing their ecosystem. This were, in some senses, a stablecoin or access coin for exchanges before fiat on-off ramps became more easy. And you do see some of the big exchanges have their exchange token as a representation of their value, and it's a proxy for people if they are bullish on a certain exchange or vice versa to trade those coins. Privacy coins, these are ones that are have enhanced privacy and anonymity for holders, typically banned in most jurisdictions due to FATF rules and due to anti-money laundering and CFT concerns. And you would not see these being permitted globally in terms of many exchanges would not have these. They're usually available through decentralized exchanges, if at all. Lastly is meme coins, quite a bit of uptick recently, but started off as a representation of meme culture, which is very popular with millennials and Gen Z. The latest one that you've seen is the issuance by the President of the United States, Donald Trump, and his wife just before his inauguration as president. But some of the more popular ones happen to be the ones that represent animals, in particular Doge, DOGE, which gained a lot of traction and has seen favor with the likes of Elon Musk, and then others like Shiba Inu as well. They don't have any inherent utility or value. They are driven by the popularity, a bit like, again, using game cards or elements that people like to be associated with, in some senses, have some similarities with NFTs, but are not NFTs, but more fungible tokens, so you could exchange them without having unique properties. This is just an overview of the major virtual assets. These are some that were typically in the top 10 by market cap and or use. So Bitcoin, of course, we all are probably familiar with, as is Ethereum, the number one and number two in that sense. You have different consensus mechanisms and distributed ledger technologies that they use, ranging from proof of work to proof of stake, and we will dive into that later in the presentation. And then the other applications include the likes of Ripple, which was primarily built for financial services and currently is the third largest, having crossed over $200 billion in market cap recently. Bitcoin is close to $2 trillion at this stage, actually a little over. And then the rest include network coins such as Solana and Cardano, but also exchange coins like Binance. Litecoin is among the older ones, created in 2011 after Bitcoin was launched as a way to overcome concerns with Bitcoin scalabilities and fees. Doge is our popular meme coin, while Polkadot and Polygon are again multi-chain and layer 2 blockchains. So here's just a quick look at market cap of virtual assets. A point to be noted, none of the conversation here or discussion during the webinar constitutes investment advice of any kind. This is solely meant for training and education purposes. Please do your own research and follow your compliance guidelines when investing in virtual assets. So this is to show the progress in terms of virtual assets market cap. As you can see, prior to 2017, 2018, it was typically well below $200 billion. But then in 2018, you saw a big spike driven by ICOs and the initial meme coins, if you were to call it, or NFTs rather, which was with CryptoKitties. Then you saw stabilization going into COVID, and then a big pickup from 2021, where it crossed $1 trillion for the first time, and subsequently touching $2 trillion and then $3 trillion over the last year. We were close to $4 trillion last week when Bitcoin touched a value of over 109,000 US dollar per Bitcoin. Bitcoin dominates the total market value, roughly over 56%, and ranges largely around 50 to 60%, while Ethereum is the second largest in value, with ranging between 10 to 15%, and they dominate most places. Your ETFs and other products typically are based on Bitcoin, number one, and secondly is Ethereum. The other virtual assets that have crossed $100 billion market cap include USDT, which is a very popular stable coin. USDC has come close, which is the other stable coin with US dollar. Solana, Ripple, XRP, and BNB. Quick snapshot of the overall ecosystem in the virtual assets world. It encompasses various elements of financial services that you typically see, ranging from exchanges, institutional trading, custody, lending, payments, etc., all the way to something which is more unique to virtual assets such as tokenization, looking at NFT solutions, mining, as well as crypto ATMs. So when we have a virtual assets, a key element of that is storage. And quite often, users who are not familiar with virtual asset storage can have issues with accessing their virtual assets, and in some cases also losing because they were not sure of the mechanism to protect themselves. Uh, Typically, this is called custody of virtual assets. You need a reliable storage mechanism, whether this is online connected to the internet or it is offline, which is what are known as cold wallets, which would store through connection offline, like you would do on a USB device. So wallets are typically issued with the public and private keys, which are linked to the specific blockchain where the virtual asset is based slash hosted. So you can think of a public key as something similar to a bank account number, which is shareable without concerns, while the private key is similar to a bank authorization password and used for signing transactions. So it's very vital that you as users, and if you're speaking to your clients, to mention safekeeping of the private key and not sharing of that. In older days, people would write it down on a piece of paper and put it in a bank locker. In today's world, you do have certain security apps and others where you can store your private keys. And we're seeing an evolution where people are using things like passkeys, etc., to enable better use of wallets. They provide protection for the keys, enable transactions, as well as for identity verification where necessary. And as I mentioned, they can take various forms from hardware wallets, which are like USBs, or could be an app on your mobile phone or desktop. And when they are connected to the internet, convenient to use, but vulnerable to online threats like hacking, where somebody may get your private key and then take control and drain your wallets, or completely take control and you won't have any access. Cold wallets, on the other hand, are preferred for higher security and in certain cases mandated by regulators for a certain percentage of virtual assets custody to be as cold wallets. So wallets can again be classified as custodial or non-custodial wallets, depending on whether the private keys are being held by the owner of the virtual assets or a third party. In some cases, you do have custodial wallets which are also held by an intermediary, which is acting as a virtual asset custodian, and by many virtual assets exchanges, or VATPs as they are known here in Hong Kong, which store these virtual assets in the mode of their business. So this is incidental custody as it's known. And they will have control over your private keys. Whereas when we look at non-custodial wallets, these are typically offered online as plugins. The ones like MetaMask, Phantom, etc., popular ones. Custodial wallets are preferred by newcomers because it provides user friendliness, because you have the exchanges or custodians helping with management of these virtual assets. Because in certain instances, if you don't store it in the right chain, you may then end up losing your assets, because certain cryptocurrencies can be used on different chains. As example would be USDT, could be on different multiple networks. And if you're not sending it across to the right network that you have the coin on, you will end up losing it, and it's not retrievable in most cases. Non-custodial wallets are self-managed, and you have full control over your private keys. However, you need to be a little more proficient technically, and the loss of hardware or private keys could leave you without any access to these funds. Typically, it's just a software provider helping facilitate your storage. And so that's a bit like cloud storage, which Amazon manages, versus you having something where you have full control. So just an example of some of the cold wallets, including some of the brands that offer, as you can see, most look like USBs or small power banks as such. Whereas when we look at hot wallets in terms of centralized ones, an example is of an exchange wallet, a Coinbase wallet that could manage it, or a custody wallet, whereas MetaMask is your non-custodial wallet. This is an important element in terms of looking at virtual assets related products. These are under the SFC's investment products which have a principal investment objective or strategy to invest in VAs, derive the value from the value and characteristics of virtual assets, track or replicate the investment results or returns, which closely match or correspond to VAs. So these can be offered to both professional investors and qualified investors, while these are likely considered as complex for retail investors, in which case you will then need to do a suitability test for the retail investors where applicable, or they will remain only for qualified institutional investors and PIs if too complex. Further, intermediaries need to assess whether the clients have knowledge of investing in virtual assets or VA products prior to effecting a transaction in virtual assets products. You would see this often in the modern case where some of the service providers would do a suitability survey and test before offering any kind of virtual assets products, be it complex or non-complex, to their clients. So in addition to virtual assets tokens we've spoken about, here are some of the examples of virtual assets related products ranging from VA funds to ETFs to ETPs, derivatives and futures, but also lending, farming, and staking products, which have a lot of similarities, and lastly, payment and banking products. Major virtual asset services that have been designated and regulated under the SFC broadly in Hong Kong include VATPs, which is the trading platforms. We've had the SFC issue licenses to a few of the platforms recently, and we have some more that are being assessed by the SFC. Users are minded to check the SFC's website for whether the platforms they're on are authorized or not to provide VATP services to them. You have VA fund management, typically for management of portfolios. This would also apply to managers with who are doing investing in VA or intend to invest more than 10% of portfolio and needing to upgrade their Type 9. Then comes VA dealing and advisory, Type 1 and Type 4, broadly speaking, where you again need to get your uplift if you are already providing securities and other products under SFC and want to do VA as well. Distribution is another element that you often see when tokens are launched. There is a need for distribution, and this is also a regulated activity under the SFO regime, and they are subject to selling restrictions and suitability requirements depending on the complexity. VA custody, currently not explicitly regulated in Hong Kong per se, but you would need the licensed VATPs to custody their own assets through an associated entity. And there is typically the need to have a trust license to custody VAs in Hong Kong if you're doing only custody. Plus, there's conversation around an update on regulations potentially in this coming year. The HKMA has also issued guidelines for authorized institutions engaging VA custody to ensure assets are safeguarded and risks are properly managed. Lastly is VA tokenization for tokenized securities, which are fundamentally securities of funds, which can be tokenized by LIs. Although the PAI, the professional investor restriction, no longer applies, offer of tokenized securities not authorized under Part 4 of the SFO or which has not complied with the prospective regime could only be made available to PIs and QIs. When we look at market data in the standard context, you have multiple sources, including the likes of Bloomberg, Reuters, etc. However, in the virtual assets world, you have different providers that range from providing trading related information to charting, but also news and market research. So some of the names here include CoinMarketCap, CoinGecko. Most of the major centralized exchanges also provide market data, research, and education. Then you have a more specialized companies such as Messari, Nansen, and Glassnode. Plus, for transaction monitoring, you have the likes of Chainalysis and Elliptic, which are often used for transaction monitoring, but also to conduct on-chain forensics. Risk of investing in virtual assets, as with any asset, there tends to be risks attached, in particular newer asset classes, which are considered alternative investment classes. It is important for doing good due diligence and ensuring that the substantial risks are taken into account. The main risks include technology risk because virtual assets are fundamentally driven by their underlying technology. So investors may not have the specific deep understanding. So educating them and ensuring they are aware of these technology risks is important. In a similar way, data privacy and cybersecurity risks are common for anything digital, and hence ensuring that some of these risks, which could be result of weak code base or weak firewalls, may lead to exploits. Lastly, on this point, you have permissionless and public blockchains which are transparent, which may lead to data privacy concerns because the data is transparent, although not necessarily directly identifiable in most cases. Transaction storage risk, as we mentioned, if the storage is not done properly, you could end up losing this into the ether. A loss of private keys, etc., is a challenge, and as well as for transfers, making sure all right wallet address and network is done. Complexity, we've touched quite a bit on that, so ensuring any complex products are well understood and offered only to those who are suitable. Market risk, high volatility has been a feature of the market for virtual assets over the last decade and a half. Volatility is slowing down to a certain extent, or coming down as we see more financial institutions coming in and more maturity, but they're still highly volatile as compared to more vanilla financial products. And hence, it's important to understand that you could have large losses over a short period of time. Regulatory risk, progress has happened in virtual assets as we've seen in Hong Kong. However, globally, this is still a work in progress and certain aspects may not be covered. In particular, elements of ownership of as property under law, you may have a regulatory element which allows for virtual assets, but it may not be recognized as property under law in certain jurisdictions. So understanding that is also quite important. Lastly is governance and misconduct, which in most cases globally in any platform or industry is a concern, and ensuring that the VA being invested has strong governance and has protection for misconduct is important. So here's a couple of use cases or case studies on major risks and certain elements that happened. One is FTX, which was one of the largest exchanges in the world. It collapsed in November of 2022 with billions of dollars of customer funds being missing. They were misappropriated or channeled into a sister company, which was Alameda hedge fund. Alameda made a lot of investments that failed and were highly illiquid, so FTX was not able to claw back that funds when clients wanted to withdraw. This led to them declaring bankruptcy. They had over 100 entities globally, and the founder of FTX, Sam Bankman-Fried, was also jailed for 25 years last year. This led to a significant increase in scrutiny of governance for virtual assets, and more regulations kicked in. JPEX, which is more closer to home for us, it was purported to be a virtual assets trading and investment platform with suspicious features. It was added to the SFC's investor alert list in July 2022, following reports of high promised returns. The case is under investigation and litigation, having impacted allegedly several thousand users who are facing large loss of funds. A Hong Kong court has ordered JPEX to return 1.8 million Hong Kong dollars in USDT in basis of considering USDT as property. So that's a good case, a law example there, but there's a lot more funds that are still being litigated and under investigation, and investors need to make sure that the platforms they're investing in are licensed and eligible and tend to have safeguards present. We'll now touch upon TradFi versus DeFi in the sense of how things have evolved and what differences are. Traditional finance is the finance we all are very used to, largely driven by centralized financial system and intermediaries such as banks, insurance companies, investment firms. Typically is intended to offer stability and trust through the underpinning of regulatory frameworks and investor protection risk mitigation. And they typically also have a higher barrier to entry with large compliance obligations and much more customer due diligence and reporting requirements. With DeFi, which is decentralized finance, which is what virtual assets typically falls under, they operate on networks which are decentralized and being controlled by multiple parties. It's built on blockchain, eliminating typical intermediaries and trying to empower individuals and bringing in newer business models meant to operate on principles of openness and inclusivity, having high permissionless transparency and interoperability. DeFi applications are also programmable and interoperable, which allows creation of customized financial instruments. In many cases, these are now being powered by smart contracts and also disaggregated trading in a lot of cases as well. So some examples of DeFi include exchanges such as Radium, Uniswap, and PancakeSwap, which are decentralized exchanges where it's peer-to-peer trading. DeFi lending platforms such as Aave, Lido, and Curve, again, peer-to-peer lending or borrowing, and margin trading platforms for DeFi ranging from DYDX, GMX, and Compound. The technologies used under virtual assets will now take a look at the virtual asset technologies of blockchains and run through these before we get to Q&A. We have discussed virtual assets, which are based on blockchain and different type of virtual assets. Now is the time for us to take a little more dive into the blockchains themselves and how these function. Largely public blockchains, which are available for any party to join, are distributed. The data here is shared simultaneously among all participants, with each party always having the exact replica of the data. So in some senses, if you used Google Sheets or Microsoft Online for Office, you will know you are sharing all of that information with different parties, and they can have real-time access to not only viewing the data but also editing the data depending on permissions that you provide, right? So in a similar way with blockchain, you have the data that's shared simultaneously, and as it's added, key difference being it is immutable, meaning once a transaction is done, it cannot be reversed. So if you were, sorry, on a Google Sheet, you could go back, if you're in row 40, you could go back to row 20, make a change, and then it changes the data below if it is having formulas. If not, that data can always be reversed. Whereas with blockchains, you'll have to initiate a new transaction to overcome the previous transaction if you do wish to reverse the transaction. So that's one key element of why blockchains are looked at for traceability in many use cases. It's trustless largely, meaning it's being validated by not by a central party, but by the ecosystem and participants. Hence, it provides more robustness from a trust perspective. Highly transparent and auditable for what data is going through and what transactions are taking place. As I mentioned, personal information would only be visible in terms of the wallet addresses typically, but not an individual's name, although there are mechanisms to try to narrow down entities owning certain wallets by some specialist providers. They're programmable. You could build in different features on top of this. So this is an example of probably the Bitcoin transaction as well. Person A requests a transaction or say a payment. This payment request is then transmitted across to a peer-to-peer network consisting of computers, which are nodes and often driven by miners in the proof of work concept. Verified that the transaction is genuine and eligible by the various nodes. Once it's verified, the transaction is then combined with other transactions during a certain period of time, which is when a new block is then added to the blockchain. And after that new period is done, you then have the transaction is noted as being complete. Now, this can range from a few seconds for confirmation of a transaction to a few hours, depending on how congested the network is, the number of transactions that are taking place at that time. So we've spoken about public blockchains. Private blockchains, on the other hand, are closed access blockchains, which require pre-approval. So in the Google Sheets example, you can have it open for everybody, or anybody who's added can only be done so by an admin or a group of admins can allow this. Public blockchains are not typically highly scalable because of relatively slower speed of transaction, because it involves a lot more number of nodes, etc. Although this was the case in the initial stages of blockchain development, we are now seeing certain L1s and layer ones and layer twos, which can be quite quick and have found solutions to overcome scalability issues with the older L1s and LOs, L0, sorry. Private blockchains have been used by certain consortium blockchains such as R3Code and Hyperledger. You also see this whereas being used in internal use cases for large conglomerates or when these conglomerates are working with their clients, so in a closed ecosystem. Typically, transaction fees are optional on these, whereas in most public blockchains, there's a transaction fees to enable the participants to cover their cost of running the nodes, etc. So different layers of blockchain loosely defined, like sometimes people would look at layer 0 and layer 1 interchangeably depending on the blockchain, but largely layer 0 is your foundational base network layer, providing hardware and internet connectivity. They also can offer cross-chain interoperability, the likes of Cosmos, Avalanche, Polkadot. Layer 1 is a base layer of a blockchain which manages transactions, consensus processes, and other frameworks. You have Solana, Cello, Ethereum, etc. as popular layer ones. Layer twos would be built on top of layer ones for scalability. This has been a very popular use case for layer twos. These include a variety of different ways of doing it, like roll-ups, side chains, or processing transactions off chain and then uploading them onto the main blockchain post that. So this can be cost effective as well as reduce the load. Polygon, Arbitrum are some of the well-known ones. Layer 3, in some senses, is an application layer. This is not a network. It's more of an application layer, which provides user-friendly platforms, essentially decentralized apps or dApps, as they're known. Layer 3 are built on top of layer 1s, or layer 2s, primarily offering a user interface as an app would, and became very popular from the time of CryptoKitties. And when Ethereum came in, this was one of the key developments that happened. Smart contracts, digital contracts that represent a type of they represent a type of digital contract which are executed automatically based on preconditions. If this then logic, they are automated workflows, a bit like when you do have your auto debit in the bank. It's essentially following a set of rules that you have asked it to. They're written in various programming languages. Ethereum was a pioneer for smart contracts and was a big driver in the adoption of Ethereum for using smart contracts and dApps. You have multiple dApps such as OpenSea, Axie Infinity, Aave, etc., which leverage smart contracts to offer decentralized applications and transactions. And similar to other elements of blockchain, these are immutable and help with you can set this in a way that it's only visible to authorized parties. So it's a mechanism just showing a smart contract that could trigger mortgage payments, for example. These can also be shared as executed with different participants, such as regulators and others. As is the case in most technology, we do use smart contract standards. So these contracts allow for different type of applications and standardization. Your most popular one in the initial days was the Ethereum request for comment number 20, which was ERC20 for fungible tokens. And then you saw the uptick in NFTs, which led to further development of newer standards and eventually the development of ERC1155, which could then do both fungible and non-fungible tokens. So here you can see ERC20, just a bit brief on what each of these functions were used for. ERC721 was more common and popular with NFTs, and then it built up. The BEP20, TRC20 are on Binance and Tron networks, while SPL standards are for Solana, and Solana having picked up in the recent cases, this standard is also quite popular. Need to be aware of the risks in smart contracts, ranging from legal risks, whether these contracts are enforceable in the local jurisdictions and recognized, and if they are not properly executed, there could be legal liabilities. As with most blockchains and technologies, technology and coding risks, as well as data risks are important elements to keep in mind. And lastly, market risks where an automated smart contract could lead to a cascading effect and market crashes when not properly executed. Consensus mechanisms are mechanisms that are inbuilt for operating and governance of blockchains, which underpin the virtual assets. These essentially are decisions and methods for taking decisions on blockchains, from how blockchain mining is done and virtual assets are produced to upgrading of the network. Because of the consensus mechanism, you would not have a centralized authority. And if you set the barometer of, say, 50% or 75% of the participants in a network need to agree, that's where the consensus come in, and only then changes are made. You then are reducing the possibilities of one or a few parties taking full control of a network and hijacking the network's operations. Three most popular consensus mechanisms include proof of work, proof of stake, and delegated proof of stake. Proof of work, the first one that came into prominence, which was utilized to secure a network and hopefully prevent double spending, which means using the same coin for two different transactions. The POV algorithm miners are required to solve complex mathematical problems or cryptographic problems as they were known, and that's how the term cryptocurrency came about. These were known as hashes. Once you crack the puzzle, you're then able to validate transactions and that have taken place during a period of time in the network, and then you can add blocks to the chain, and the miners or group of miners who do it get rewarded with cryptocurrencies in a specific period of time. They operate through nodes, and this can take up a significant computational power. So when you heard about crypto taking up huge electricity power, this was largely due to the use of POV, and the node broadcasts the block to other miners for verification acceptance, and once it's validated, you move on to the next block. So as I mentioned, with Bitcoin, the puzzle's difficulty is adjusted every 2016 blocks, and the reward has also been halving every 4 years. So we now are at a much lower value to where it started at $50, 50 Bitcoin per block, and now we are moving towards people exploring going away from POV and implementing what is known as the proof of stake. So in proof of stake, in the consensus mechanism initially introduced by Ethereum network and adopted by Solana, Cardano, and Algorand and others, is to reduce the computational resource requirement, and it can be less than 1% of a proof of work network. In this case, validators have to put in as collateral in some senses some of the project's native cryptocurrencies while they are validating transactions. So which means you have something at stake, and hence the term proof of stake. This again these are allocated randomly by the network based on how much has been staked, and you do see that there's been a significant reduction in electricity uptick based on this. So when we look at risks in staking, when an investor stakes, they're locked in. So it's like a fixed term deposit. So it's important that people are aware of the lock-in period. Also, it is important to understand the liquidity risk during high volatility, where people may lose the value based on market fall. Lastly, is also when we're looking at fraudulent transactions or through slashing, it is important validators are aware and are able to mitigate those risks. Finally, it is common for people to lend their tokens for staking. So if you're passing on your tokens for staking, be aware that the borrower may lose this if they haven't done the right governance during staking. Next one, please. So a brief comparison of POV versus POS. You have the deck and you can have a look at it. But in effect, cost of operation, impact of use of electricity, as well as in terms of finalizing a malicious block, there are more hurdles in POS, which is more popular, whereas POV is largely being discounted by newer products. Last one on this before we go into Q&A, we have about 5 minutes for Q&A, is on trust frameworks. These are again technology governance frameworks which cover the life cycle of a blockchain solution. It is important for organizations to maintain a strong framework for trust and cover various vulnerabilities, as we have touched upon, from key management, associate party risk, scalability, standards issues, or security issues. Hence, it needs to start from the time the coding and development is done all the way to maintenance of the network while in operation, and it needs to be regularly updated to mitigate newer risks that may come up. For example, quantum computing coming out may create newer risks for certain networks. So having a trust framework would be important to manage those risks and ensure safety and security for the participants on the network. And with that, we have come to an end for the presentation. We have a few questions and we will address that. Not going too deep into proof of history and others, but essentially once you first had the conversation around proof of work, because that was the more popular mechanism and for cracking cryptographic puzzles, it was an important element for people to be able to track and be able to participate. And once that problem was solved of ensuring that you can use less electricity, you then have proof of work, you have delegated proof of work, you have proof of history, all of which are developing consensus mechanisms of validation of how a transaction has taken place in a decentralized manner. And depending on different networks, you may end up in 3 to 5 years' time seeing something else come in as a consensus mechanism. So the key thing to keep in mind here when you are dealing with your users as well as dealing with the networks is consensus mechanisms largely are applicable when you are operating a node, right? And you are participating actively. But as a end user, the key element to understand with the consensus mechanism is how long is this likely to take and when is the transaction likely to be confirmed, right? I'll give an example I'll give is a couple of days back when the Trump coins were launched, and I went on to Solana as it were, and was trying to transfer Sol from one wallet to another wallet to purchase the coin. But when the transfer between the wallets from one exchange to another decentralized platform, typically it is meant to happen within a minute to 2 minutes, but largely quoted as 10 minutes. It actually took over 2-3 hours for it to take place because there's a big surge in the network. So the available nodes at the time, which is probably around 6 a.m. Hong Kong time, if I memory serves me correct, would have been was not as high on Solana, so they could not process it. So there's a long wait time. Transaction fees were fairly okay. In Ethereum, you would see that often in Bitcoin as well. When there's high demand, high congestion, and high requirement, the transaction fees can go up, right? Because you are then looking for miners who will will look at your transaction first because they're getting incentivized to do it. So validating your transaction. So miners can earn money 2 ways in proof of work in particular. One of which is through the doing the cryptographic hash and solving the puzzle. On the other side is just validating individual transactions and taking them up to add to the block. So that transaction fees can vary. In idle low time, it can be not very high, and the network would also be easier to operate in. Whereas during high rush and demand, your complexity of hashing increases, so there's more computational power required, and the transaction fees goes up. Same with we saw CryptoKitties initially when Ethereum was launched, essentially clogging the whole network because there's a huge demand for CryptoKitties, and then you need gas fees, which is the transaction fees on Ethereum. So this would be a few ways of this. Yeah. The question around, I think I'll take the second question on keeping up to date in a fast-moving field, as well as what's the view on Trump coins and impact on VA. So second question on keeping up to date, a lot happening quite often. I mentioned some of the data sources and news sources ranging from Cointelegraph, Messari, others. There are a lot of good newsletters out there as well. So follow those, keep up to date. Do keep in mind following SFC circulars on this topic. I'm sure you must be subscribed to their circulars. If you're not, please do. So following social media and Twitter and others is probably one good way because there's a lot of activity happening and news updates, especially on Twitter. There's almost this whole story of crypto Twitter, or X as it's now known, taking the question on Trump coin and the impact on virtual assets market. It is early to see what the final impact will be. For those who are not aware, Donald Trump issued a meme coin called Fight, Fight, Fight just the day before his inauguration. And the market cap of which went into $60 billion at one stage. And it's come down since, but then his wife also issued one. So this will have an impact in terms of how tokens are issued in the US. It's likely that there may be some changes in how the regulations are done for issuance of meme coin or raising funds using meme coins, which under the SEC could have led to some actions in the previous regime. There's now a newer regime in terms of a new acting head and a permanent head to be appointed in the coming months. So we may have that impact. But secondly, it is bringing on board a lot of users who are not very familiar with crypto because they are maybe Donald Trump followers and they are buying these meme coins as a way of supporting and associating with him. So they will be, I would say, like NFTs brought in a new wave of people joining the virtual assets world in 2021, 2022. This meme coins may bring in more of the retail crowd into the market. So be aware of these, but also please keep in mind that meme coins typically have no utility, aren't meant to have any safety or risk, and legal liabilities are very minimal, and hence they can be much more volatile and can go up a lot, but also can fall. Like we saw with Donald Trump's coin, went up, fell 40-50% when the Melania Trump coin was launched, and then it's further down since then. I think we are now on time with this, so thank you all.